Hi everyone, my name is Colin, Research Manager at iFAST Research and Portfolio Management Team. So Japanese equities have been on a blistering run, as many of you may know. So with the domestic equity indices like Nikkei or TOPIX hitting decades high recently. So this rally has in fact reassured our call for Japanese equities, which we have been positive on since last year. But despite this fierce rally, Japan remains one of the top equity market picks for us in both the near term as well as the longer term. So in this session, just let me share several key reasons why we believe Japan's rally has staying power. All right, so first, let us take a look back at the history of Japanese equities to first understand why we think Japanese equities will move higher. You can see that Japan's stock market has came a long way, in fact, very, very long way. So after the asset bubble burst in 1991, I'm sure many of you may remember, the economy went through a decade of stagnation, and on top of that, companies went into survival mode as corporate earnings plummeted. You can see that by the black line over there. So many companies afterwards started to hoard cash. They became very prudent. They cut back on capex, they cut back on R&D, and also at the same time, they were also frantically deleveraging because many of these companies has high debt built up throughout the bubble age. So they have been trying very hard to clean up their balance sheets. So stock markets and corporate profits were in fact quite flat throughout the 90s. You can see that from that period over there, 1991 to 2003, which is the famous lost decade. So this finally ended in 2012 when Japan's economic regime began to shift after Abenomics came into play. So that happened around the end of 2012. So the economy experienced higher growth afterwards. Inflation began to pick up, like what we've seen recently. Tax rates were cut tremendously. And on top of that, companies' net gearing fell drastically as they deleveraged even more. And ultimately, corporate profits exploded higher. You can see from the black line there, we see that exploded higher and supporting the stock market's climb. So in short, you can see that the asset bubble burst. Afterwards, corporate Japan spent 10 years cleaning up and another 10 years to recover. So right now, it is at levels where we see almost back at 1991. So as we look ahead, we do believe that the market has what it takes to make the next climb. So over the next few slides, let me share the reasons why. All right, so let's start with the first reason, the ongoing reopening tailwind. So since Japan reopened, tourism spending and household consumption have been firing on all cylinders. So let's take a look at both of these drivers. So starting off with tourism, I'm sure many of you here have been to Japan since it reopened last October, and in fact, maybe more than one time as well. So before the pandemic, in 2019, the tourism sector contributed around 7% of the nation's GDP. So that is roughly equivalent to 360 billion USD. So let me put things into perspective. So this amount is almost equivalent to Singapore's 2019 GDP alone. So since Japan reopened, you can see from the chart on the left, the tourism has rebounded very, very fiercely. So over the past 12 months, since end of April, there has been a massive 330% increase in tourist spending, providing a huge boost to consumption. So despite this dramatic rebound, we do think that there is still room for tourist spending to climb. So right now, based on our estimation, there is the tourist spending is still 90% of its pre-COVID level. And based on Japan's official projection, tourism spending is expected to hit pre-COVID level this year. So moving on to consumption activity, the other important driver. We also find that domestic spending has been consistently higher throughout the past few years. So as shown on the chart right here, since Japan exited its state of emergency, consumption has been increasing steadily, and that is being led higher by services. In fact, Japan's higher inflation does little to impede domestic spending, as consumption has rebounded steadily in real terms. That is accounting for inflation. So you can see that from the chart on the right, the clear, strong growth in consumption after it reopened. So Again, more importantly, consumption activity is still roughly around 91% based on our estimation of its pre-COVID trend. And that also implies that there is still much more room for consumption to grow back to pre-COVID level. And we are not even talking about surpassing pre-COVID level as we move ahead. All right, so looking ahead, we do expect a consumption-led growth in Japan this year, and we already can see that happening over the past 2 quarters. So with consumption around 2/3 of Japan's GDP, we believe this should compensate for weaker export numbers, and at the same time, it adds resiliency to economic growth. And during this period, especially when your global headwinds are mounting. So as a result, we do expect Japan to deliver stronger economic growth over the next 1 to 2 years as compared to other developed markets like the US and Europe. So our expectations remains aligned with consensus, which also forecasts Japan's quarterly GDP to surpass the peers as shown on the chart here. You can see that from the dark red line. So overall, we do believe Japan's rosier economic backdrop should provide very strong support for its equities, especially against developed market peers like the US and Europe. All right, so the next reason why we are positive on Japan is Japan's fundamental strength for its corporates. So since the COVID trough, revenue growth for Japanese companies have surged, while at the same time, profit margins have also hit cycle highs. So even during the most recent financial quarter, which in fact is quite challenging for companies around the world, more than half of the Nikkei 225's companies managed to either beat or deliver earnings in line with consensus. So as a result of this strong earnings beat, this has resulted in a U-turn in earnings revision for the Nikkei 225 index. So you can see from the chart on the left where earning estimates for the index have been revised higher, in fact, very recently. And this suggests greater optimism from analysts towards Japanese equities. So this can also be seen from Japan's rosier earnings outlook, highlighted by the chart on the right. And you can see that consensus expect earnings for Japan to grow by strong double digits over the next 2 years, far surpassing developed markets like US and Europe as well. All right, so we do think that analysts' expectation of a strong earnings growth from Japan is deliverable. And this is expected to be led by the tech sector, the healthcare sector, financials, as well as consumer discretionary sector as well. So Japanese tech sector is well supported by 2 things. The tech sector is right now well supported by a rebound in semicon as well as software company earnings. So this is led by global names like Avantis as well as Trend Micro and NEC. So many of these companies that you guys may have heard of. And also many of you may not know that, but Japanese pharma as well as biotech industry are also world-class. So in fact, this industry has seen a surge in earnings during the pandemic, strong double-digit earnings, and is also expected to maintain strong earnings growth even during an economic downturn. So Japanese financials at the same time have also seen a surge in net interest income, which is due to a solid demand from capital from Japanese companies. So with this expected to continue, and also the likelihood of higher longer-term yields, Japanese banks as well as financial services companies are expected to maintain their earnings strength. And last but certainly not least, Japanese consumer discretionary companies. We do believe that there are a huge support to overall earnings growth. So many auto players like your Honda, Nissan, and many of these established names are seeing a revival in sales growth. And at the same time, other consumer goods company like your gaming company like Bandai Namco, for example, are also seeing a surging sales growth. And this is supported by strong consumption tailwind happening in Japan right now. So with all this support from major sectors, we do think that Japan's earnings outlook looks promising if you look ahead. Additionally, if you look at Japan's corporate balance sheets, we do see that they are in a strong position right now. In fact, as the chart on the left-hand side shows, the amount of cash for Japanese companies have surged 250%. So 250% over the past decades to record high. And this is because operating conditions have improved in Japan over the last decade, as I've shown in the chart, in my second chart. So what do I mean by that? If you look at the past decades, we see that margins have more than tripled. Corporate earnings have grown by almost 400%. Corporate tax rates were in fact cut by nearly 10%. And at the same time, borrowing costs fell drastically as the Bank of Japan went into negative interest rate policy. So another impressive feat, as shown on the right, is that close to 50% of Japan's listed companies are net cash. So what do I mean by that? Which is that companies have more cash than total debt. So these companies have more cash at hand. So more than 50% of Japan's companies are net cash. And this is impressive because it is more than double that of the US as well as European listed companies. So all these are important as Japanese companies are now entering an economic slowdown with cash-rich balance sheets, which they can deploy to either defend their operating performance or quickly recover for their businesses. And the third reason why we like Japan is also because of the stock market's room for valuation expansion. While valuations right now, as you may wonder, for the Nikkei 225 has increased after the rally. But what we see is that forward PE is only around its long-term average. So you can see that from the chart by the left. So this implies that valuations are still fairly fair right now. So also, let's take a look at the chart on the right. So if you can compare Japan's equity valuation against the US, which has also rallied in the year to date, or even the developed market index, you'll find that valuations for Japan are much more attractive. So both the S&P 500 as well as the Nikkei 225 index has rallied about 18% in Sing dollar terms in the year to date. Both are about equal, and in the first 6 months. But US equities right now, they are about 12% overvalued, while Japan is only trading quite fairly. So while valuations are around the long-term average, we definitely see room for valuations to move higher. So if you look at foreigners buying and selling of Japanese equities, we find that foreigners have greatly bought Japanese equities right after Abenomics. As you recall what I showed earlier in my second slide, after Abenomics, the economy went up, the economy went strongly. And we can see that here, that foreigners are buying Japanese equities right after that period. But unfortunately, after that period, Japan went into the bear market in 2016 and followed by the trade war afterwards. So foreigners have been heavily selling Japanese equities for the past 6 years. So more recently, we see that foreigners have entered the Japanese market, seeing the strong growth as well as the better investment case. More foreigners are entering the market, but you can still see from this chart here that Japanese equities are still chronically under-owned as compared to what we've seen in the past decade. But also at the same time, if you look at data, it shows that 10% of Japanese households' assets, 10% of that are in equities, only 10%. And there is certainly more room for retail participation. So overall, should Japanese equities see more inflows coming from foreigners, coming from their domestic markets, we definitely think that valuations can move higher, driving equity upside. So this is very possible considering the corporate reform momentum that is going on right now, and also a potential exit from deflation, which many will cheer for, and also because of its earnings as well as economic strength. So beyond the near-term factors, we believe that the long-term case for Japanese equities has become much brighter, and that is adding to our conviction as well. So one major factor is that corporate reforms are making a breakthrough, as I've alluded earlier. So as shown on this chart right here, Japanese policymakers have made it an objective to improve corporate governance. So they have went to the companies and established laws to tell shareholders that, hey, please deliver more shareholder values for your shareholders. And this has been an arduous journey that started 10 years ago, as you can see from this chart here. But unfortunately, since the pandemic, these efforts were halted. However, as the economy reopened, policymakers are again making a strong push for corporate reforms. So this time, and more recently, the Tokyo Stock Exchange have begun pressuring companies with low PB ratios to more efficiently distribute their capital back to the shareholders or potentially be delisted. So this has been very effective as many companies have responded with buybacks, more dividends, as well as improvement measures in the recent months. And those have benefited shareholders as of the recent past couple of quarters. So should policymakers continue with their reform efforts, we can see that Japan will quickly become a hunting ground for investors seeking stocks that are not only fundamentally sound, but also provide better shareholder value. So another bright spot in Japan is the banks. So there are several reasons why Japanese banks are well positioned. So let me first start off with valuations. So valuations for Japanese banks remains attractive as compared to the US peers. So the Japan's banking sector as a whole trades on a PB ratio of about 0.7 times. This is quite a stark discount to the US banks, which is trading at about 0.8 to 0.9 times. And you can also see that from the chart on the left-hand side, the yield curve for Japan remains non-inverted. So this is something that is very different from major economies like the US, for example, which are seeing inverted curve. So a non-inverted curve greatly buffers the net interest margin for Japanese companies. Furthermore, we do think that Japanese bond yields, especially longer-term ones, have the potential to move much higher. So with the country's stickier inflation pressure and possibly an exit from deflation, we do think that there is increasingly high chance of the Bank of Japan making adjustments to its yield curve control and allowing longer-term yields to fluctuate higher. So to put things into perspective, if you look at US 10-year Treasury yields right now, they are close to 3.9%. Whereas Japan's 10-year yield are close to 0.39%. So this is 10 times lesser, and therefore a new era of potentially higher longer-term yields in Japan should greatly drive Japanese banks' performance. As you can see from the chart on the right-hand side, higher yields has historically been a strong catalyst for Japanese banks, and we have a strong chance of entering a regime of higher yields in Japan. So another bright spot, and perhaps the most exciting one for me to end off, is the potential for Japan to take back the tech sector advantage. So we do think that this starts from its semicon industry. So right now, Japan's semicon industry is in a sweet spot, firmly bolstered by both your global as well as domestic factors. So geopolitical tensions, I'm sure you guys might be aware, over the past 12 months, over the past 24 months, and those geopolitical tensions have been rightly about the global chip supply, and they have motivated companies to re-establish and strengthen their own supply chain. So as such, many of these world's strongest, largest chip makers like Micron, Intel, as well as TSMC have made plans to invest in Japan, and also by building major plants and major R&D centers. So you may wonder why Japan? And the reason is fairly simple. So Japan stands out as an attractive destination due to its generous subsidies, well-developed infrastructure, skilled labor force, and also not forgetting the existing expertise in chip production. And also on the domestic front, the Japanese government is pushing to grow the local semicon industry. So for example, Japan's industry ministry targets to triple the sales of companies manufacturing semiconductors to 15 trillion yen by 2030. And with both the external as well as domestic push for Japan's semicon industry, we see the potential for accelerated growth in this industry over the next few years. And we do think that the revival of Japan's semicon industry will light the path for a potential tech push in the coming years. All right, so before I conclude, once again, here are the 4 reasons why we like and recommend Japanese equities. And looking ahead, we do think that Japan has what it takes to perform in the long run and expect the Nikkei to hit 40K by fiscal year 2025, which is end of March 2025. So this should translate to a handsome 26% upside potential as of the current prices. So with that, I've come to the end. Thank you for staying through this presentation, and thank you for your time.